Hi, thanks so much for joining in. This is Your Money Matters on NDTV Profit. Like the name suggests, we talk about everything personal finance related. And today we're focusing on mutual funds and your investments and your portfolio of mutual funds. What normally happens is that most of us are reactive when it comes to our investments in mutual funds. And very often, we don't get ahead of what could be a problem down the road. What I'm talking about is the drawdowns that you've probably seen over the last 2 to 3 months in the broader market funds, small cap and mid cap funds. Now, what the role of certain mutual fund schemes is in your portfolio is to limit the downside. And I'm talking about the role of hybrid funds. I'm talking about balanced advantage funds. I'm talking about multi-asset funds. Their role is to serve as something of an anchor in your portfolio. They don't give you outsized returns on the way up, but they also protect your capital on the way down. Of course, you need capital appreciation as well, and that's where small and mid cap comes in, but you need to balance it out. Have these schemes managed to protect your capital is the question that you should be asking at this point, and how do you decide what should go into your portfolio? Joining me to talk about it is Prableen Bajpai, the founder of FinFix Research and Analytics. Prableen, thanks so much for taking the time. Always a pleasure having you. Let's first establish what role these schemes play in the portfolio. What my viewers have currently is my interpretation of it, but they're here to listen to you. So why don't you tell us?
Good afternoon, Alex. Absolutely. I think as investors, majority of us want the best of both worlds, which is downside protection and participation when the markets are on the upside. And hybrid funds, and we are specifically talking about 2 categories within hybrid, which is the balanced advantage or the dynamic asset allocation and the multi-asset allocation funds. And I think these two have done, majority of the funds have done a great job doing both. So there has been downside protection, and they have been able to deliver returns when markets have been in the bull run and have performed well. So theoretically, they're supposed to move across different asset classes. For example, balanced advantage funds are supposed to move between the debt and the equity allocation. So they're supposed to change this percentage depending on the markets. And the multi-asset allocation funds also have an additional composition of gold/silver in their portfolios. So they move across 3 different asset classes. And that is how this movement, depending on their own assessment of how markets are, where there is opportunity to make these allocations, and they're able to provide decent returns with downside protection. But having said that, it's not the same across the category. But broadly, Alex, if we see, for example, the recent fall of since September till about February 11th, 12th, if we look at that, Nifty has been down by about 12%. And if you're looking at the balanced advantage funds as a category, it has been down by about 7.5%. So 5% lesser than Nifty 50. And if you're looking at the balanced advantage fund, we're moving to multi-asset funds. As a category during this time period, it has been down by about 5.86, almost 6%. So half of Nifty's fall. And then within these, of course, the performance has really varied. There are schemes which have been able to minimize the downside to just about like 0.3, 0.4%. But there are also schemes within the balanced advantage where the fall has been as high as 20%. And likewise, in the multi-asset allocation, there have been 2 funds actually which are in the positive. So plus 2.86%, and that's the highest performance within the multi-asset allocation during this time period. It has given positive returns, but the worst performance has been around 19%. So majority of the funds within these categories have been able to restrict the downside with a single-digit fall as compared to Nifty 50 at 12%. But then there are a few, let's say about 5 to 10%, where the fall has been in line with Nifty or even more than Nifty. But specifically speaking, there are just 2 or 3 funds which have fallen more than Nifty 50 in both these broader categories.
Okay, so let's delve a little deeper, Prableen, into why this disparity exists in these strategies, because ultimately it is because these fund managers or fund houses are interpreting this balanced advantage fund as performing certain roles and responsibilities in an individual's portfolio, and it has to do with the way that they are allocating towards equity. But before we get to that, if we talk about these 2 categories, would you say that looking at the asset allocation, if you study the fact sheets on a monthly basis of these schemes, then looking at the way that a fund manager or a fund house is approaching its balanced advantage fund, you can get a sense of how its equity strategy by and large is going to be. The reason I ask this is that if a fund house is moving away from equity and even within that balanced advantage fund is gravitating towards large cap, the interpretation for me would be that they are risk off and they feel that they want to protect capital, and that should give you a sense of what they think for the equity allocation or the pure equity schemes as well.
Absolutely, Alex. Actually, that's a very interesting way of looking at it. So, for example, if I'm looking at SBI Mutual Fund, and their balanced advantage fund for almost the last 1 year has held equity at, let's say, 32, 35%. Highest probably was 37, 38%, then coming down to 28% by the end of December. So that definitely tells that they were a little cautious about the markets and the sentiments that, markets were going up, and they were slightly looking to protect and, have a conservative stance. Likewise for ICICI. So depending on the fund house, Motilal, on the other hand, has had higher allocations, for example, towards equities. So yes, definitely DSP has had lower allocations. So depending on what their approach is in their hybrid funds, I think that definitely conveys a broader mindset towards equities or the other classes of equities that they are managing. So I think as a fund house, their philosophy to some extent definitely gets reflected through their hybrid funds.
Okay. What I also want to do, Prableen, in this conversation is to explain with examples how some of these strategies differ. So first, let's talk about the balanced advantage category, which is also called the dynamic asset allocation category. And why is there such a wide divergence in the performance? Obviously, it has to do with the choice of the fund manager in terms of how aggressive they want to be in equity, right?
Absolutely, Alex. So each of these fund houses, for example, within the balanced advantage fund category, which is about 2.82 lakh crores. So it's a big, huge category. We got flows of about 1,500 crores in January in the category. It's a big category. And during volatile times, if we look at, 21, 22, when there was volatility in the markets, a lot of new NFOs were launched actually within this category. And each of these fund houses has a different philosophy, which is broadly set out. If you're looking at their fund presentation, if you're looking at their fact sheets, you can understand. And if you're especially tracking the net equity exposure. So for the understanding of your viewers, Alex, any fund which is a balanced advantage fund will hold equity and will hold debt. But to be able to get the benefits of equity taxation, they also add arbitrage. So there is hedged equity and then there is unhedged equity. So when we are talking about how much equity they hold, we are currently talking about unhedged equity because that is what will take the hit when markets correct. Hedged equity is as it is okay. It's hedged and it's safe. It's arbitrage. So across fund houses, they have their own in-house mechanics on the basis of which they get these indicators. For example, somebody understands sentiment, so they have a sentiment indicator. Somebody looks at valuation, somebody is looking at PE, somebody is looking at PB. So they have different models, and based on these models, their net equity is adjusted. But there are some fund houses which broadly take an aggressive approach towards allocations towards equities, and that is something that the investor at the time of putting their money has to understand. So I'll give an example of Parakh Dynamic Asset Allocation. This was launched in February of 2024. So it's barely a year old. In fact, end of this month, it will turn a year old. So it holds up to 35% in equity. And this 35% is hedged plus unhedged. So it qualifies for equity, but then you have to hold it for 2 years because it reaches that 35% mark. And it holds unhedged equity only up to 14 to 15%. So their own philosophy is that we're going to have some equity exposure, but we're going to keep it low. And that is what helped actually this fund tide over this crisis period. And they had decent allocation to debt and arbitrage. So, that worked in their favor. Second example would be SBI Balance Advantage. It was launched in 2021. And over these months, since its launch, I think it's about 45 months since it's launched, it's been able to beat Nifty 50 on a monthly basis, 41 out of these 45 times, actually. It has outperformed the Nifty 50, yet been able to protect the downside. because they've been agile with their movement of reducing and increasing the equity exposure, which they've not taken very high. In December end, Alex, this was at 28.77%. And now at the end of January, they've actually increased it. And now it is at 42.51%. So probably some buying was there done in January. And during the whole of last year, it was maintained in the 13s range. A dynamic asset allocation by DSP has been one which has maintained its allocations in unhedged equity in the 30s level, and it has been able to protect the downside. So within these fund houses, the approach, the models that they hold decides. And Motilal, for example, they've been aggressive, and that is what has caused them this sharp fall. They've fallen the most within the balanced advantage category. They've fallen by 20%. And they were holding somewhere between 60 to 65 throughout the last year. And we didn't see any reduction in their net equity exposure, even post-September. So that definitely tells that as a fund house, they're going aggressive, even in this category, which ideally should not be too aggressive. In the bull run, it works well, but in such times, then it somewhere defeats the purpose of being in a balanced advantage.
Yeah, and one would assume that in a bull run situation, which took place between 2021 all the way up to one could argue August of last year, these schemes, or at least some of these schemes that had a higher equity allocation, would have done well and would have considerably beaten the benchmark, and in fact it would have beaten the more conservative peers as well, one would assume.
Yes.
And I'm pretty sure the data will back that out. The question is, if you're talking specifically about these balanced advantage funds, Prableen, I know that traditionally people have said that this is for those individuals that do not want to take calls on allocation of capital. But ultimately, I've also been told on the other side that it does not replace the need for asset allocation. So how do you marry the two? How do you get the two together? And how much of your portfolio should go towards a DAF or a balanced advantage fund?
So I think some of the don'ts for investing in a BAF is while investing, in fact, in a BAF or a multi-asset allocation, that number one, Alex, that these are not risk-free. So if somebody is telling you that you move your money from FD and you put it in a balanced advantage fund or a multi-asset fund, it's not going to be risk-free. On the rolling return basis, if you're looking at 3-year and 5-year rolling returns, definitely there are no negative returns in these categories broadly. But it's not risk-free, and you should still have the appetite to digest these cycles, in the market, which is when Nifty is down by 12%. There has been a period of 16% fall in October 21 to June 22. So you should be able to do that. So that's a no, that it's not risk-free. Second, that there will be fall, and the fall will be dependent on the scheme that you're holding. So you just cannot go by the broader category. The investor must look and dive a bit deeper and see which scheme within the category is most suitable. And then you have to get sort of frustrated during times when there is a bull run, because maybe your BAF or your multi-asset fund may not be able to catch up on the upside. So you have to be content. Your objective has to be very clear, Alex, when you're investing. Okay. And you cannot leave asset allocation at scheme level. That's the third point. That's very important. So I feel somebody who's looking at a lesser volatile journey has an investment horizon of 3 to 5 years. So people who are suitable for is somebody having a 3 to 5 year horizon. Today has a lump sum, is not having the appetite to invest in equities directly in equity markets, wants a hybrid product. For them, it's good. For somebody 10 years later or 7 years later wants to start an SWP, for them, it's okay. And broadly, any person with a moderate risk appetite. So, these are certain scenarios where I feel that these funds really can fit well. But then you have to still, one step down, and you have to understand which scheme within these categories are you investing in. So you have to know both downside and the upside potential, and then downside protection, how much it can protect.
Okay. So we've talked about some strategies, but I before we move to multi-asset fund, I want to ask you something, right, Prableen? So from the way that you've described what the purpose of this category is, and you've also talked about a few examples where you think that the strategy is being done appropriately, what should the return expectation be? Because when you have that, when you say normally you're talking about equity in a large cap fund, you're talking about a nominal GDP plus a couple of percentage points, right? So you're saying 10% plus a couple of percentage points, you're saying 12% normally is your expectation. But
Right.
a BAF would be lower than that. So when you set your expectations, where should it be?
Interestingly, not all BAFs have given lower than Nifty,
Yeah.
Alex. So
Yeah,
on the
no, but I'm
upside,
saying to
some of
which is fine. But I'm saying the question is, Prableen, when you make your expectations for the future,
yeah,
and you're
setting
saying,
them.
yeah, you're benchmarking your expectations. So you say if you get anything beyond this, it's great. You will achieve your target faster. But you have to benchmark those expectations. So where would you peg that?
So I will say that you take your FD. So if your FD is giving you 7%, and you add somewhere between 3 to 5% on based on the philosophy or the fund that you're. So I think 7 plus 3. In some scenarios, it can be 10%, going up to 12%. That's where you should set your expectations.
Okay.
But lower double digit, I think, is a reasonable expectation. If you stay put in the scheme for 3 to 5 years. Alex.
Yeah. So that provides perfect clarity heading into the conversation on multi-asset as well. Would you say that, so ultimately this is the similar approach, but you're adding more asset classes? Often you're talking about gold as well. And to a certain extent, this is a perfect example of a diversified approach helping you when the chips are down in one particular asset class. Because gold since 2024 and in 2025 has been an incredible run. Whether this continues or not is a different matter, but at 10 to 15% allocation in certain portfolios of multi-asset funds, this is providing a very nice kicker. Wouldn't you agree?
Absolutely, Alex. I'll give you an example of White Oak Capital multi-asset fund first. It has been up 1.56% since September till February 12th, which is really good when Nifty is down by 12%. And they hold about 35% in equity. So again, to qualify for equity taxation, post 2 years, they hold this. But their unhedged equity was roughly around 24% as per the last fact sheet. And they had almost close to 20% in gold. So I think gold really helped them during this time period. So the right allocations within these, which asset class you want to be becomes really important in the multi-asset allocation category. Edelweiss, for example, has a very conservative approach of running its multi-asset allocation fund. So it says that we're going to hedge everything. So they hedge their equity. So all their equity is totally hedged. So Alex, whatever they're holding is going to be hedged, and they also hedge their gold and silver, interestingly. So on the downside, they've been able to protect and in fact deliver plus 2.86% return since September 26th till February 12th, which is amazing. It's the highest return in the category. But given their conservative approach on the upside specific to this scheme, I would say that the return expectations will need to be on the higher single digit to lowest double digit. So I don't think that returns in this specific fund can go beyond 9 to 10%. But if you're getting equity taxation there and everything is hedged in the portfolio, it's still not bad. It's an interesting combination. It's a different philosophy of their, how they run the fund. Motilal, I'll have to touch upon it again because that has actually fallen the most in this category. The worst performance with 19.5% fall during this time period. And I think the problem again was the aggression on their unhedged equity. So unhedged equity still remains high, 60% plus in a multi-asset fund with gold at about 12%. So 12% gold was good. So mostly all these funds somewhere keep a double digit in gold. Let's say it can vary from 10 to 15, 20%, 25% also in gold. But the unhedged equity was very high. And again, the role of debt was less. And that is why the fund has really got the beating. So within the multi-assets, some of the funds, for example, ICICI, which is a very old fund in the category, has done pretty well, Alex, over the years. If you look at its 5-year SIP returns or the 5-year CAGR, it's at about 20%, which is amazing with downside protection. In this time period, it had fallen just by about 4.5 to 5%. So if you're getting a category which is able to protect the downside and deliver decent returns on the upside, I think it's a win-win. But again, investors need to understand that it is not the solution to their asset allocation, number one. Second, that the performance, of course, going forward can vary. And thirdly, that they have to see that how and where does it suit and sort of fit in their overall portfolios, and keeping expectations still at FD plus 3 to 5%. I think that is what you should move with.
Okay, so in the last leg of this conversation, I want to talk about slightly different topic, which is that there's been a lot of noise about mid-cap and small-cap, Prableen, and what investors should do based on the kind of drawdowns that you've seen, and also certain comments by a very prominent voice in the mutual fund industry. Have you gotten calls from your clients asking, what should I do? Should I be selling lock, stock and barrel?
I have definitely got the forward of that video, Alex, from many asking on what to do. And I think the answer is so respected. And he's not wrong in saying what he said. But I think as SIP investors, of course, number one, when investors are, if they're investing in these markets, they need to have clarity, Alex, on the investment horizon. So if my investor has a 7 to 10 year horizon, I'm not worried. But let's say for any investor, if he has overexposure to the mid-cap and small-cap space, and it's far breached the levels which was decided, let's say, at the time of investment, then definitely some profit booking. Not now, actually, it should have been done, let's say, 6 months back. That if it's exceeding in markets when they're doing well, you should trim and invest in those categories which probably are underexposed for you. Secondly, if any of the goals are near, again, Alex, there has to be profit booking which needs to be done. So if a goal is 1 or 2 years away, definitely you need to book profits. And irrespective of whether you are over allocated in a certain category or not, because the goal is close. And we say that in equities, if your goal is 3 years away, you start reducing your exposure and you start saving for the particular goal. You start taking out the profits. But third, if your allocation is low, if you have a 7+ year horizon, then I feel that these are the times when, as an SIP, because that is the basic premise on which SIP is based, that you continue during downturns. And if you have the stomach to withstand 0 to negative to very minimal returns for the next 3 to 4 years, then definitely continue. But if you don't have the stomach for that, then I think then you are in the wrong category. So as a small cap or a mid cap investor, we need to be prepared for lesser returns, even lesser SIP returns in the next 3 to 4 years. And it has happened in the past. If you look at 2018, 1 year SIP in 2019 was giving like minus 27% returns. By 2020, it was negative 3-4%. By 21, it was in positive. So theoretically, when we say these numbers, Alex, it's easy for investors. Okay, my SIP will come in positive. But you still have to live through that painful time. And if you cannot live through that painful time, it's better to exit when, there is still time. So if there is a further fall, SIPs will reward because you're buying in during the downturns and they will reward you, but then have a longish horizon, which is at least 7 years, I would say. And if you can't do that, then I think it's time to reject.
So Prableen, then the question is, and I know a lot of people have suggested this, right, to keep things simple. Ultimately, complicating things also makes things difficult, right? So if you have a certain amount of allocation, just ensure that if it's a 5 percentage point or 10 percentage point deviation from that on either end, then you correct it. But what is the maximum, in your opinion, that you should have in a mid-cap and small-cap allocation in a portfolio, even if it is aggressive?
So, Alex, I think it really depends on the investor and, what they're looking to do. But definitely on the higher side also, like let's say on the highest side, even if we take a aggressive investor, your small caps should not be more than 15% or so. If this person is really savvy, and we do have investors who actually have 20% in small caps, and they are totally unmoved by the current volatility. So their SIPs are continuing. So it really depends on how many cycles have you seen in the market as an investor. Are you comfortable? Do you have another 10 years ahead of you to keep investing? But overall, let's say about 35-ish% in these two categories, 35 to 40% for an aggressive investor as well.
Quick last question. If you are seeing losses in your portfolio, is it, and if you are overexposed, Prableen, would you say that take some money off the table and book that capital loss? Because ultimately, there is a provision to allow for the setting off of that capital loss against future gains.
Absolutely. So if you are getting uncomfortable, Alex, because investing, it's a personal journey for everybody. If you're uncomfortable and if you say that you decide, no, I'm in loss, but I want to stop and exit. Then if you were doing an SIP, then some of your gains would be long-term capital gains and maybe some of would be short-term capital gains. So there is a provision, long-term capital losses. I'll correct myself. So long-term capital loss can be set off against long-term capital gains. And any loss can be carried forward for 8 financial years. But you need to report it in that financial year. So I can't go back. I was talking to somebody, he said, I had losses and I didn't show it and something. But then you can't go back and correct that in 2020, I had a loss and now I want to carry it forward. That is not possible. So you have to report it during that financial year. But then you can carry forward the losses for 8 financial years and set it off against your gains from maybe 2 years later, 3 years later. So it is not a bad idea if you are uncomfortable, even if you're in loss and you are okay with, trimming your portfolio or allocation, you can definitely book your losses and then set it off against gains going forward. Short-term losses can be set off against long-term as well as short-term gains.
Okay, fantastic. And that's great advice. Don't stop your SIPs is what I'm also taking from this conversation. Prableen, thanks so much for joining in and for this lovely conversation. Always a pleasure having you on the program.
My pleasure. Thanks, Alex.
All right, that brings us to the end of this edition of Your Money Matters. Thanks so much for tuning in. Do stay tuned. Lots more on NDTV Profit.